McGraw-Hill Professional presents The Caterpillar Way: Lessons in Leadership, Growth, and Shareholder Value. Written by Craig T. Bouchard and James V. Cook. Narrated by Gary Macfadden. Chapter 1. The Quest for the Holy Grail. This book is about greatness, and specifically about Caterpillar Inc., a superb example of a once struggling company made great by a deliberate sequence of astute management decisions. Caterpillar today is the world's leading manufacturer of construction and mining equipment, diesel and natural gas engines, industrial gas turbines, and diesel-electric locomotives. Financial analysts say that its global market share is increasing, and that it is churning out profits. But things weren't always this way. In 1984, Caterpillar lost $1.17 million every day as it suffered through its third down year in a row. There were whispers that bankruptcy could be somewhere down the street if Cat, this is how most people close to the company affectionately refer to it, could not turn things around. However, turn things around is precisely what Caterpillar did, even as many similarly situated firms fell into the ditch. In 2012, Caterpillar was ranked number 46 on the Fortune 500 list of the largest American corporations, up from number 58 the previous year. Its composite revenues and sales were $65.88 billion in 2012, a tenfold increase since 1984. In November 2012, Caterpillar's annual sales were 1.9 times as large as those of its nearest American competitor, Deere, and 2.7 times the size of those of its largest international competitor, Komatsu. Between January 2, 2001 and January 2, 2013, Cat's stock price rose an amazing 443%. While the S&P 500 increased only 12.3%. Further, the company's dividend per share increased 269% between 2001 and 2012, and now has increased 20 years in a row. By any standard, these achievements represent conspicuous success and help define what it means to be great. Nevertheless, the topic of good versus great is once again in vogue because on closer inspection, so few things seem genuinely great. Not in the United States, not in Europe, and not in the BRICS, Brazil, Russia, India, and China either. Consider the implications of this assessment. It's increasingly difficult to find the qualities usually associated with greatness either in countries or in companies. The BRICS, for example, used to be synonymous with dynamic economic growth, but now that their growth has decelerated, they appear more vulnerable, and it is possible that they may lead the world into recession. It seems apparent that the global economic environment has changed, perhaps not forever, but certainly for the foreseeable future. As authors and as businessmen, we have glimpsed greatness a few times during our careers. Truth be told, getting a small whiff of it in our prior experience building S-Mark Inc. and Shale Inland, both billion-dollar steel-related enterprises, made us eager to explain why some organizations are able to scale to higher levels of productivity and performance while others flame out and fall short. We sense that we're not the only ones who want to know why. This is a topic of great interest not only to directors, CEOs, and managers of companies, but also to investors, large and small. Unfortunately, never in our lifetimes have so many managers and investors been so confused and uncertain about what constitutes the path to great business performance. In today's equity and bond markets, this insecurity translates into massive doubts about how and where one should invest. It is not a mystery why this is so. Unmistakable uncertainties exist with respect to Europe's ability to work through its financial crises. The Middle East is a tinderbox. the Chinese economy has slowed, and Japan appears to be in the middle of yet another lost decade. In the United States, no one really knows how the new healthcare legislation will work or what it will cost. Nor do we know what our tax rates will be next year, much less 5 years from today. How will we pay for anticipated spending on entitlements? Our burgeoning national debt waits to be paid by future generations. The list of uncertainties is long. Hanging like a cloud above all our heads is the reality that 14.3% of Americans were unemployed or underemployed in June 2013. Regrettably, this means that many millions of individuals are being forced to start over in their careers, sometimes at a terrifyingly late stage of their lives. Some have responded bravely to these circumstances by taking the plunge and starting a new company. Not only do these entrepreneurs need to make the right choice with respect to what kind of business they should start, but also they need an understanding of what generates organizational greatness, so they can rely on these principles from the very start. In light of the fact that only 8% of new businesses reach 29 employees within 10 years, individuals investing their precious cash reserves want to know how new firms can grow to become great firms, as well as how to plan for the troughs in economic activity that inevitably will occur. Even the more fortunate among us face uncertainties because the world is in constant flux. Who is willing to stake his or her 401k balance on what the relationship between Israel and Iran will be 5 years from now? Who is capable of telling us what the capital gains tax rate will be 5 years from today, or whether the promising reshoring of manufacturing into the United States will continue? Hence, even those who are invested intelligently today could experience unanticipated financial distress tomorrow. We all have a need to know how to identify management excellence within firms so that we can utilize that knowledge in the stock market. Thinking about today's investment environment. James Tobin and Harry Markowitz are academic titans. Each won a Nobel Prize in economics for advancing our knowledge of the best ways to invest funds and develop optimal financial portfolios. However, in the decades since Tobin and Markowitz won their Nobel Prizes, investing has become more complicated. Ways to invest have grown appreciably since the 1980s, and these new opportunities usually are more complex. Consider financial derivatives. Although some kinds of derivatives have been around since the 1700s, until recent decades they were not much more than a gleam in a financial innovator's eye. Today, a bewildering variety of derivatives exists, the most simple of which are forwards, futures, and options. Less than 1% of investors in the stock market ever dabble in derivatives because it is too difficult for most of them to estimate and price the risks involved. Structured investments, such as those containing subprime mortgages, did not exist when Tobin and Markowitz were doing their pioneering work. Investment opportunities in commodities and real estate certainly did exist, but the alternatives were plain vanilla compared with the intricate opportunities that exist today. Exchange-traded mutual funds had yet to appear on the scene. Thus, the number of available investment opportunities has multiplied in number and increased in complexity, and this has made investing more complicated. One of the biggest changes in the habits of investors is that many now choose to index their investments to reflect the entire stock market. Sometimes they don't know they are doing this because their pension fund invests their contributions and they don't pay much attention. In other cases, they personally choose to invest in indexed mutual funds sold by firms such as Fidelity and Vanguard, funds that attempt to imitate the entire stock market. For most investors, indexing turns out to be the optimal strategy. After all, accumulated evidence suggests that the typical individual investor or hedge fund that targets individual stocks does not do as well as the market overall, and frequently does worse. This means that many individual retail investors no longer spend much time consciously evaluating the characteristics of specific firms. Most investors have given up investing in people. That is, they no longer take into account the values and behaviors of those who lead companies. We believe this is a mistake. We believe it makes a huge difference not only what one invests in, but also who leads the companies in which one invests. Who is going to lead the parade remains a salient investment question because leadership makes a significant difference in company performance. Who is leading the firm? What are their values? How do they go about conducting their business? Private equity funds continually ask these questions, though their collective performance suggests that they don't often end up with the right answers. Institutional money managers ask the same questions. Alas, most retail investors don't know how to ask these questions or discover the answers. In an odd way, the investment models of Tobin and Markowitz are responsible for the modern de-emphasis on the human component when one invests in stocks. Their classic models focused on two critical variables: the mean return one could earn on an asset and the standard deviation of that return. The duo didn't worry about the identity or values of the leaders of the companies whose financial assets they were analyzing. Tobin and Markowitz passed over any complications in this regard by making the usual ceteris paribus assumption that underpins so much of economic theory. That is, they held constant quite a few variables, such as managerial abilities and values, and implicitly assumed that those factors were not crucial considerations. The work of Markowitz and Tobin was path-breaking and deserving of a Nobel Prize because their theory underpins modern portfolio analysis and the well-known capital asset pricing model. Wall Street fell in love with their formulations and adopted their way of looking at things. Of course, it is essential to know which firms have generated the highest average returns in the past and how variable those returns have been. But portfolio analysis is not helpful in figuring out when a star performer on the New York Stock Exchange, NYSE, or NASDAQ will hit the wall and bog down with management issues associated with fast growth and scale. We've cited Caterpillar's magnificent performance and could assemble a portfolio of firms to invest in by relying on similar track records of growth and stock appreciation. However, as television ads constantly warn us, past performance is no guarantee of future returns. Next year will bring different circumstances. What will the firm's managers do when faced with adversity? How will they react when, like Caterpillar, they are faced with strong new international competition, and their exports are burdened by a strong U.S. dollar? What path will they choose when, like Caterpillar, they face a well-funded, entrenched labor union, such as the United Auto Workers, that is insistent on imposing an industry-pattern bargain solution on their firm that they believe is not in the best interest of the shareholders? What course of action will they take when, like Caterpillar, they conclude that their current organizational structure is obsolete and ought to be changed? Great firms have managers who answer these questions as well as the questions we do not yet know. This underlines a basic reality. If you are not going to index your investments, you must pay attention to the quality of managers, the nature of the managerial processes they follow, and the way they arrive at decisions. James Tobin, 1918 to 2002, won the Nobel Prize in 1981. He is notable not only for his work in portfolio theory, but also for developing the Tobin regression specification for sensor-dependent variables and his proposal for a financial transactions tax, the Tobin tax. Harry Markowitz, born in 1927, won the Nobel Prize in 1990 primarily for his groundbreaking work in identifying efficient investment portfolios. He was involved in starting one of the very first hedge funds and, in that context, developed computerized trading algorithms to optimize that hedge fund's decisions. The changing investment environment. Take a peek at your 401k or pension account. How has it been doing? The answer for many people is a bit embarrassing. Their account balances are smaller today than they were 10 years ago. This should come as no surprise. As already noted, between January 2, 2001 and January 2, 2013, the S&P 500 stock index actually rose only 12.3%. During that period, the Consumer Price Index, CPI, rose 30%. In real terms, the S&P 500 index declined by about 18%. No wonder many investors feel they have been bashed by the market. These computations don't include dividends paid by S&P 500 firms, but if we generously approximate those dividends at 1.5% per year, the total value of an investment that imitated the S&P 500 rose by about 30%, or about 2.5% per year. However, if we once again deflate this gain by the CPI, the real value of an investment that imitated the S&P 500 over this period virtually stood still. Buying and holding the S&P 500 was a disappointing proposition in the period 2000 to 2012. The moral of the story? Today, it is folly for most investors to assume or expect high rates of return on equity or debt portfolios. After all, in early July 2013, a one-year U.S. government note yielded only 0.124%, and a 30-year U.S. government bond yielded only 3.683%. Federal Reserve Chairman Ben Bernanke informed all who cared to listen that these rates could persist for some time into the future. If he's right, rates of return earned on bonds are likely to be minimal. If he's wrong and interest rates rise, the prices of bonds will decline substantially. This rise in rates will hurt bondholders because lower bond prices will puncture what easily could be interpreted as a bond price bubble encouraged by Federal Reserve policies. There have been changes in the nature of the risks attached to investments as well. In the past, individual investors could reasonably assume that their investments in the stocks of large banks and public utilities and the money they put into corporate bonds were safe, secure, and substantially immune to bankruptcies or default. This view of the world, however, was badly damaged by the 2008 demise of Washington Mutual, $307 billion in assets, the meltdown of the Fortune 500 public utility Montana Power, the sudden disappearance of Wall Street's Lehman Brothers, and the bursting of the real estate price bubble. Investors now realize that the size and fame of a firm provide no guarantee of intelligent management of that firm. Lehman Brothers, for example, had accumulated assets of approximately $600 billion and enjoyed a sterling reputation. But it became overleveraged during the 2008 financial crisis and had to declare bankruptcy, still the largest one in history. Meanwhile, investments in residential real estate turned out to be notoriously bad between 2008 and 2011. The average equity that homeowners held in their houses fell from almost 60% of market value in 2000 to only 43.1% in the second quarter of 2012. Our homes may be our castles, but they haven't been wonderful investments. Declining real estate values are an important reason the Pew Foundation reported in August 2012 that median household net worth had fallen from $152,950 in 2008 to only $93,150 in 2010. Contrast these dismal results with the performance of Caterpillar. As already noted, between January 2, 2001 and January 2, 2013, the price of CAT stock rose 443%. Add to this a dividend payment that averaged about 2.3% annually. Such dividend payments are likely to continue. The company's public commitment is that it will pay dividends that will rank CAT in the top 25% of all S&P 500 dividend payers. This leads us to the central question. How can we identify the qualities and characteristics of firms that become better as they grow larger and reach higher levels of scale? As we will discuss later in the book, it's not a foregone conclusion that bigger is better when it comes to return on shareholder equity. One need look no further than the performance of famous brands such as Microsoft, Walmart, Bank of America, and General Electric, GE, to illustrate this point. A shareholder buying and holding these stocks for the last decade did not do well. There are many reasons why these large firms did not excel, but the simplest one, diseconomies of scale, is probably the best one. At some point, these firms became so large and complex that their managers and directors lost their grasp of their basic business drivers. It doesn't take lots of analysis to reach this conclusion. Just read the newspapers. J.P. Morgan lost $8 billion in 2012 because a small, decentralized trading group incurred losses in European sovereign risk markets. J.P. Morgan's CEO, Jamie Dimon, acknowledged that he was taken by surprise, a rare circumstance for a CEO labeled the best banker in the world. The Mexican management team of Walmart embarrassed its CEO and the Walmart board during 2012 by earning front-page headlines in the New York Times for what the Times described as rampant violations of the Foreign Corrupt Services Act. These alleged violations involved Walmart personnel bribing local Mexican officials to grant permits for new stores. Walmart's grief was the product of two corporate deficiencies: the absence of a strong corporate ethical tradition that would have discouraged or eliminated such behavior, and the difficulty Walmart's central managers had in managing and monitoring a huge, decentralized company with a large global reach. GE Capital and Bank of America expanded into the home mortgage business, and both found reason to regret it during the Great Recession of 2008 to 2009. Both companies lost billions of dollars despite their large scale and seeming competence. Bank of America's acquisition of Countrywide later was mocked by the Wall Street Journal as possibly the worst deal in history. Microsoft enjoyed a near-monopoly position in the computer desktop software industry with its Windows products. The global market for its software grew by leaps and bounds, and the company accumulated large cash balances. Nevertheless, the price of its stock began to languish when it became clear that the company had become a follower rather than a leader in reacting to developments such as the Internet, could not fully exploit search engine technology, was unable to capitalize on social media, was slow to find ways to harness cloud computing, and was a laggard in producing actual machines rather than software. Bad management makes a difference. The Montana Power Company's very name suggests that it was a company involved in generating electric power. It was highly regarded in the 1990s, and its annual sales exceeded $1 billion. However, late in the 1990s, advised by Goldman Sachs, the company's management decided to get out of the power generating business and instead go into telecommunications. It sold its power plants for more than $3 billion and restructured itself into Touch America Holdings, which constructed a 21,000-mile fiber optic network. Alas, this turned out to be disastrous, and by 2003, Touch America had filed for Chapter 11 bankruptcy. Bad management choices equals bad results. Why focus on Caterpillar? Caterpillar has taught itself how to scale to higher and higher levels of performance even as its bitter rivals, Komatsu and Deere, give it their best shots but nevertheless fall back. The story of how Caterpillar did this was told to us by the very people who made it happen, as well as by their competitors. These conversations and our own observations provide an instructive journey through the corporate decision-making process. But why focus on Caterpillar rather than on other successful firms? Because our research led us to the conclusion that CAT has been an exemplar in dealing with change, confronting challenges, and positioning itself for the future. It has been flexible and intelligent in its decision-making. Plainly expressed, Caterpillar has met the market test better than has any other large industrial firm in the United States. Its ability to scale its size and performance upward is a remarkable story, as is its ability to cope with economic recession. However, before we tell you the Caterpillar story, it will be helpful if you know a bit more about us. This will help you evaluate what we have to say. The authors of this book, Craig Bouchard and Jim Cook, have run large businesses and have a first-hand sense of the kinds of choices, often unexpected, that confront leaders. Craig Bouchard has been a manufacturing company CEO, president, board member, or board chairman for 2 decades, and in the 1990s ran a global derivatives trading room that spanned 4 continents. Jim Cook is a highly regarded economist and was a university president for 15 years. Jim was named one of the 100 most effective college presidents in the United States. When we assumed our various leadership positions, we inherited institutions that either appeared to be drifting or were racked by problems. We turned them around. Craig masterminded what is still the only successful hostile reverse tender merger in Wall Street history when Esmark, the firm he founded, took over the Wheeling-Pittsburgh Steel Corporation in 2007. Craig, however, wasn't finished. In June 2013, he won another hostile proxy battle, this time taking the reins of Signature Financial Holdings. We described these exciting times in our 2009 book, America for Sale: How the Foreign Pack Circled and Devoured Esmark. Here's a nutshell description of what happened. In the friendliest way possible, we asked Wheeling-Pitt's 2,000-plus shareholders, including a score of large institutional share owners such as Tontine Associates, Fidelity, Wellington, and Mellon, to vote out 9 of the company's 11 directors at its annual shareholders meeting. To the surprise of virtually everyone, we convinced the investors of the superiority of our plan for Wheeling-Pitt's future and won the proxy battle. We, Jim was a member of the Esmark board, subsequently dispatched the 9 directors, the CEO, and many of the senior managers. Hostile moves of this nature had been tried by Carl Icahn and others. None had ever been successful on the scale we accomplished. In August 2008, we sold Esmark to A.O. Severstal, the Russian steelmaker, for nearly $1.3 billion, with the founding investors receiving 20 to 40 times their investment. However, this wasn't easily accomplished either. We first had to defeat the attempt of the United Steelworkers, USW, to force us to sell at a price less than what the market commanded. We won that battle with the USW in a binding arbitration before the National Labor Relations Board in Washington, D.C. The $1.3 billion closing on the Severstal deal occurred less than a month before the most devastating crash on Wall Street since the Great Depression. Esmark became the highest appreciating stock on the NASDAQ for the full year 2008. Great timing? To be sure. We confessed that we did not anticipate the intensity of the Great Recession, though we did predict that the U.S. steel industry was in for extended hard times, and did see a credit crunch building up like Hurricane Sandy. Forbes magazine covered the story nicely in its January year-in-review edition, branding Craig and his brother Jim Bouchard as the American Men of Steel. We're a nonpartisan team politically. We'd best be described as middle-of-the-roaders, politically speaking. We don't have any political axes to grind and often cross party lines in our voting. So now you know something about us. However, the key to understanding us is that we are...
Sample complete. Ready to continue?